Good morning, everyone, and welcome to our webinar, Affordable Care Solutions, the Power of Short-Term Care Insurance, with Regional Marketing Director Derek Lape. Today's webinar will be recorded and then later posted on our website. This does mean that all attendees will be automatically muted so that we get a quality recording. If you have any questions, go ahead and type them into the chat box, and we'll try to answer them throughout the presentation. But if we're unable to get to all the questions, we'll have a member of our marketing team reach out to you individually to make sure you get that answered. Before we get started, we'd like to invite you to join us for our next webinar on Tuesday, April 15th at 9 a.m. Pacific Time. Join Regional Marketing Director Nisha Catron for MedSup Success, Adapting to Change with Confidence. And with that, I'll hand it over to Derek so that we can go ahead and get started. Take it away, Derek.
Thank you, Jordan, and good morning to a lot of you, and also good afternoon to some of you on the East Coast. So today we're going to be going through affordable care solutions, basically short-term care for most of you guys. Some of you may have heard it called or used the term extended care. They're kind of interchangeable for what we're talking about today, but we'll go ahead and start diving into this. So really what we're going to be going over, obviously why we're all here, a little bit of what it is, what's going on, what the current client mindset is, what they're kind of looking for, what they're hoping for, different things like that, why it's becoming such a big market, in this time frame for everybody, and really where it fits in. So also kind of a way to present some different solutions, go through some of the different conversations, kind of key phrases. We're not going to go too in depth. This one should be a pretty quick webinar, especially from what you guys are used to from me, because we're kind of just doing a general overview for a lot of people who are considering, pivoting into some different areas where they can sell some different things and some different options. And really with how popular short-term care is becoming, it's a great option. So that's what we're going to be doing today. All right. So really why we're all here, obviously everybody knows the need for critical care, assistance, whatever you want to call it, hasn't decreased at all, right? It's really only been increasing. The problem is cost is a huge one when you're looking at the market, as well as lately getting people to qualify, right? So when you're looking at traditional long-term care, standalone long-term care, whatever you want to call it, it's getting pretty pricey for a lot of people, and a lot of people don't qualify. So for instance, I am 39 years old. I do not qualify for any long-term care, right? Now, I played football most of my life up into college and then went into the Army. So as you can imagine, I got a little beat up. But it's just kind of something that's showing you, it's a pretty hard product to get for a lot of people, right? Like I said, I'm under 40 and I can't even get long-term care. So it's one of those things where it's just becoming more and more difficult to get. It's a great product for those who qualify, and especially those that can afford it, but there's a huge need for those who don't qualify and who can't afford it, who still need to get care down the road, right? So that's where kind of short-term care is going to come in. It's a lot simpler for the underwriting process. You can have as little as basically one question, which is, are you currently meeting any of the ADLs or have any cognitive issues? No? Perfect, here you go, right? Or it can get a little bit more intensive on the underwriting side. You might be looking at maybe 5-6 questions, but still a lot less than looking at an entire booklet, right, of long-term care, exclusions, whether it's for different medical conditions or medications they're taking. The other thing that we're kind of here is a lot of agents and clients don't know much about short-term care, extended care. It's something that's been out there. It's something that's out there. It's really kind of changing right now with what some of the carriers are doing as far as the builds of short-term care. But a lot of people don't know about it, right? They just kind of know, oh, there's long-term care when I need to get care. Oh, it's too expensive. Okay, next, right? And we're kind of trying to change that mindset because the short-term care market is really exploding, right? It's affordable, it's easy, it's quick. It's something that just is a huge opportunity for agents who are kind of leaving it, out there for other agents to do. With that, we're entering a time, and depending on which poll and stats you look at, right, millennials have passed baby boomers or about even as far as the largest population. right? So when you're looking at ages of 61 to 79, of what a lot of agents were focusing on in that baby boomer generation to try and get them insurance, a lot of those people are going to be a lot older. They're probably not going to qualify for long-term care in the numbers they used to, or it's going to be really expensive for them, right? Because they're used to living off a fixed income at this point for however long. Now, some of them are still aging into, like I said, they're under 65, but it's just becoming less and less with each year because they're getting older each year, which is kind of nice because then you're bringing in, Generation X, which is around 45 to 60 years old right now, right? And there's about 65 million of them. Baby boomers are still around 71 to 73 million, depending on which poll you're looking at, right? And then for millennials, right around there, 72 to 73 million, right? So big chunk of block. We're seeing this kind of shift in the age and who the primary target markets are going to become. And this is also kind of helping with long-term care, right? A lot of the carriers are starting to push going for a younger, all the way down to age 50, kind of focus for what they want to start pushing these apps towards, right? So there's something there, and with that, it's just getting harder and harder for that baby boomer generation to qualify for long-term care if they don't already have it. So this is kind of a nice fix. Having said that, you can't get this in every state, right? So as you guys know, AIM, we're located here in Washington State. There's no short-term care options, right? Unfortunately. But it is just something where you got to be aware of it. You got to see what's going on and kind of look. For most of the country out there that, the states you guys are in, this is going to be an option. There's going to be quite a few options. It's really a great product, right? And with that, let's jump into a little bit of more of what that modern client is kind of becoming, right? As we're going into new generations of people stepping up and kind of what they're looking for in plans, it's not quite the same as what it used to be, right? So a lot of these newer generations, whether you want to talk about Generation X or the millennials who are starting to kind of age into that cusp of looking at all these senior care products, right? They like things to be easy. They like it to be quick. They like it to be, something where they feel like they have some flexibility and power in it. With that, there's not as much of that in traditional long-term care, right? It's kind of, you put it there, rates may or may not go up, as we've seen for most of the industry on those older long-term care policies. They do go up, right? So it's something where there's been a lot of apprehension for some customers. That's usually kind of one of those hurdles you have to overcome when you're selling it. It's not hard to overcome it, right? But it is one that pops up a lot. Are these rates going to increase? That's a little bit harder to do when you're talking about a pretty big price point for premiums. It's a little bit easier to do when you're talking about a pretty inexpensive product like short-term care. So that's where that kind of fits in there. With what you're looking at here, a lot of clients will kind of put off planning, right? There are things they don't want to think about, right? Especially with the mindset that we've had for so long of, long-term care, short-term care is going to be for going to a recovery center. It's for going into a home. It's for those kind of things. And with that, we'll get into that a little bit more, but we're trying to kind of change that perception of this is more for you recovering, right? It's not going into a facility necessarily. It does cover that, but that's not the main point, right? So it kind of helps shift that focus a little bit for the modern client mindset of what they're kind of looking for, what they're worried about. And they're still youngish, right? As we're talking about like that Gen X and the millennials getting into it, right? We don't really love to think about ourselves having to be in that situation. Now, some of us do, right? We've seen that happen with our parents. We've seen it happen with loved ones, friends who are a little bit older. And we see the need for it. Like we've seen it firsthand how, much that can really hurt a financial situation and all the family members around when someone has to get that care and they don't have anything in place. So it's kind of a little bit to think about and take in when you're getting into these talks versus kind of that older school approach, a little bit of kind of scaring clients into buying a policy, right? I know a lot of us don't like to admit that, but even when I started in insurance, oh geez, over 10 years ago, it wasn't too long, right? Not very long ago. It was still very much make them think of the bad things that can happen, right? So not necessarily really scaring them, but making them think about all the bad things and this is why you need this. And that mind shift of, getting into these products, selling these products has really changed away from that, right? You're kind of more gently guiding them to a solution. Right. So this is something you've probably talked to a lot of marketers about here in the office. Something I really like to point out, a lot of times when you're talking to clients, especially when they see, the different price points of some of the products, they'll sit there and say, oh, I'm going to self-insure, right? So I just want to clarify a little bit when you guys are talking about this, and some of you probably already know this, but this does get used interchangeably a lot. They are slightly different when you're talking about self-insuring versus self-funding, right? So what a lot of people say, they're self-insuring, what they really mean is they're going to be self-funding. So I'll give you kind of the difference between the two, right? Self-insuring is saying, I'm going to take, and at this point, especially when it comes to long-term care and stuff like that, you basically need to be able to take about $1 million, set it aside in some kind of savings account and not touch it for anything, right? That is purely going to be for your critical care down the road, right? That is how you self-insure. You take a chunk of money and you set it aside and you do not touch it, right? Versus self-funding is, well, if something happens, I'm going to pay out of my pocket, right? Because I'm healthy, nothing's going to go wrong. That's going to be self-funding, right? If the need arises, they're going to pay for it when it comes down the road. So they don't really have anything set aside. As you probably notice, and when you think about it, self-funding is going to be the riskiest thing they can do, right? Just because they have the money now doesn't mean they're going to have it when they need it. There's going to be inflation. There's going to be, ups and downs in the markets. They could lose a job, right? There's so many different things that can happen between now and when they need that care that it makes it really risky. Smart planning, and you can call it whatever you want, right? But basically, you're going out and you're getting a policy that is going to help cover all or some of those costs, right? You're going to be just really reassigning the risk to the insurance company. That's what you're paying them for, something you don't have to worry about. It's nice because it gives you predictability, right? You know more or less, and yes, some of these premiums can increase, but just bear with me here. We'll just say it's going to stay. You know more or less what your premiums are going to be. You know exactly how much to budget for. You know what's going to happen. You know what's coming down the road, right? Versus if I have a stroke, right, and I lose my job and I can't work and I didn't actually self-insure, I self-funded, am I going to have money to do this, right? So that's kind of the real cost of doing nothing. I mean, when you're looking at different care, right, in today's world, on average, and this is going to vary state to state, but if someone does have to go into a facility or even get, home care, they're looking at probably $50,000 to $100,000 a year, right? It's a big number, and it's one that is increasing every year. And it's something that a lot of people who are hoping to self-insure or self-fund don't really take into account of how much that number really is. And also the fact that they're going to have to stop working, right? If they're hoping their loved ones are going to take care of them, depending on what they need, they may have to stop working too, right? So there's a lot of different factors that go into this. And this is something where you can kind of walk them through this, right? You can kind of show them on a simple level like we just did here, you're going to have to come up with $100,000 a year or $50,000 a year. Can you really afford that if you're self-funding, right? And once again, we're going away from the scare tactic, but we are making them think about things. We are making them look at different possibilities of what could happen. All right. So some of you guys out there are brand new. When I called you to give you reminders about this, basically short-term care insurance is just a recovery-based care, right? That's what we're looking at. We're trying to kind of change that mindset. Like I said, this isn't a facility benefit. This isn't something where you're going to be in there. While you do have that coverage on some of these, and some of these just are short-term home health cares, right? When it comes to different carriers, but it's something that's going to help you recover, right? Whether that's at home or that's at a facility, it's something that's there to get better, right? This is short-term care. It's only going to give you up to about 360 days, depending on the carrier and the option you select in the state, right? So it's not going to be for 3, 6 years till you're in there, till you pass away or whatever the case is. This is just going to be there to help get you by in the short term. Something to help kind of offset costs. There's some other benefits, right? But really, it's just there for that short term need. As far as daily benefits, I mean, this is just the averages. A lot of people are looking for $100 to $300 a day. It is in there. It's something that is going to be, depending on which carrier and product you select, it can be very limited in the underwriting, very easy to get, very, very inexpensive. We'll get into some pricing here in a little bit. Or if you're talking about like a Recover Cash with GTL, it's almost like a long-term care light. And what I mean by that is you can build in inflation. You can adjust the different benefits for both home care and for facility care, right? You can play with all kinds of cool stuff, just like you're building a long-term care policy. The difference is it's going to only be up to 360 days, right? So great product, a lot of different flexibility there. The biggest benefit about what it is its price and how easy it is to get. As far as who's buying this, it's more or less the same clients that you're looking for long-term care. Quite honestly, a lot of the same clients you have in your MedSup book, right? Med Advantage, different things like that, where they're in the age range where they're seeing friends, they've seen family or loved ones go through this, right? So pretty much the same demographic you're looking for at long-term care. The big difference for this one on who's buying it is you're going to get a lot more people who see the need for care, but they can't afford that traditional standalone long-term care, right? Or they don't qualify for it. So it's going to be a good option for that. And it's going to help you get kind of around some scenarios where you get declines, you get people who love the idea, but you just can't get the price down low enough to make sense, right? So you're going to get a lot of flexibility. And it's going to be a very easy pivot because when we get into the pricing here in a second, you're going to be talking about, 50 to 160 bucks a month versus, $400, $500, $600 a month. So it makes it a lot easier to sell. And it really helps. I think most of the pushback I get is a lot of agents will be like, oh, it's not a huge benefit. It's not a long time, right? But when you're talking about what you get for the price, it is a healthy benefit, right? It is a big benefit for that year when you build it. It's very inexpensive. And most of the consumers who are buying it kind of weigh that in their head, right? Like, oh, yeah, not as big a benefit, but it does give me something. And it's a lot cheaper. I can swing that, right? I can afford the extra $80 a month. So that's kind of who you're going to be looking at as far as the clientele. No need to dive into that too deep because, like I said, it's pretty similar to what you've already been looking at if you've been in the long-term care market. Excuse me, I had a cough. All right. So where this is going to fit in, it's going to be basically like we were talking about. If you have someone who gets a decline, it's a good fallback. It's a good bridge to help with MedSup and retirement planning, right? It helps complement annuities, life insurance, even the hybrids, and make some different, not only coverage that isn't necessarily met by some of these other types of insurance that are out there, but also it gives you a little bit of stickiness, right? And what I mean by that is if you're in the MedSup market and that is mainly what you're selling, even if you're in a state like Washington where it's a free-for-all all year round and you can sell it all year round, if that's all you have, it's going to be a little bit harder to keep that customer retention because that product is based mainly off of price, right? You've heard it many times. A plan G is a plan G. which is true to an extent, right? Not every carrier is exactly the same as far as service and stuff like that. But a lot of consumers have been taught that it is price, price, price for med subs. And they may love you, but if you don't have a certain carrier or you can't offer it, they might leave. Versus if they have something else with you and it's a very inexpensive product that they're going to like, it's going to help take care of their needs, it's going to fill some of those gaps, they're more likely to stay with you when another agent calls them and they're like, hey, I can save you $5 a month on your plan G, right? It helps with that customer retention because the more products they have with you, the more likely they are to stay there. Plus, like we talked about, you're actually taking care of their needs, which is pretty important. But it's one of those things that's going to help take care of them. It's going to be there for whatever they need. And also, it's going to help with your retention. As far as what's going on there with benefits, the add-ons, we already talked about daily benefits. Most people are picking between $100 and $300 a day. When it comes to elimination periods, there's going to be a wide array. It's really popular for a lot of people to pick between 0 and 20 days just because the price is so inexpensive. Also, you're only talking about a year of coverage here. So a lot of people just jump on at day 0. It really doesn't change the price that much for most of the carriers out there, whether you're talking about Aetna, GTL, whatever products you want, right? Pretty similar as far as pricing is going to go. Benefit periods, there's a wide array. Most people will usually pick pretty close to the year just because it's so inexpensive to get that year, right? As far as popular riders, some of the carriers are going to have, that RX indemnity, the prescription. It's a really nice one. It kind of helps offset the cost of the product quite a bit because most of the people, as they're getting older, especially in the US, are going to be on some kind of medications. So it's kind of nice for them to get some cash back, right, each time, which is going to be pretty helpful. Caregiver training is becoming a big one. Those who are hoping to kind of mitigate some costs by having loved ones take care of them, there's going to be some different riders that'll help fund and pay for that, which is nice. Restoration of benefits is a huge part of this, right? So most of the carriers are going to let it renew after, so many days, so many months. A little bit different carrier to carrier, but they usually let you do it up to 2 times. So if someone has a stroke and they use this the first year and they get all better and everything's good and they go, let's say, another year before something happens, which is much longer than they need to, but just for this scenario, those benefits are going to restore, which means they get them all over again, right? And for most of the carriers, like I said, you can do that up to 2 times. So you're getting pretty close to getting a 3-year long-term care policy, right? Because it resets. The difference is you can't do it for 2 years straight. You need to pause and get off and come back on. But it is a nice benefit, right? It's something that if someone has a stroke and they need some home care or whatever the case is, it's going to help meet those needs and take care of them. And they're not going to have to go through losing, maybe $50,000 to get someone to come take care of them at home for 7 months while they're recovering, as well as not being able to work at their job while they're recovering, right? It really is going to help out quite a bit. And then let's jump into the cost. So as you can see, I kind of just did average builds. I didn't put the builds in here just because there's a lot to look at. So somewhere around 185,000 total, which works out to about $5,000 benefit a month on the long-term care side. I did put a 3% inflation on there, right? Because on the short-term care side, I did the simple, home care, and then on that higher end, I did kind of like the recover cash cost with some inflation built in. So I made these very similar as far as the benefits per month. Obviously, the long-term care is going for about 3 years. Short-term care is going for 360 days. But it's a really good example of getting more or less the same monthly benefit. But on the short-term care side, when you're talking about a 50-year-old couple, you're talking about $60 to $100 a month versus $451 a month for long-term care, right? For a 65-year-old couple, about $90 to $170 a month versus $625 a month. So while the benefit period is, one third the length, more or less, you are saving a lot of money. And when people are looking at the dollar amounts, it is much easier for them, especially when they're on fixed incomes, fixed budgets, to come up with that smaller number, right? For a couple, $60 a month, right? Versus, ooh, I don't know about $451, right? That's a car payment. That's a that's a big number. Um, but it's one of those things that makes it pretty digestible and easily, you know, it's a very easy product to place when you're talking to these different couples. Even when you're talking to the 65-year-olds, right, who are aging in, they're calling you for med subs, different things like that. You're worried about different gaps in their coverage. Maybe you don't talk about it day one, but you mark them down on the list, right? Maybe you ask kind of a feeler question of, oh, do you have any kind of critical care coverage, right? And just to go back to it another day, and then a month or two down the road, right? Once you're out of AEP, you give them a call and set up something to talk about this, right? It's a lot easier to get them to bite on that $90 to $170, and it's a lot easier to get them to qualify than it is for that long-term care of 625, right? So it's a really good kind of entryway to get into this. Normally, what I would suggest is if you're going that route, I would start by talking about long-term care and all its benefits and getting them to realize that it is a great solution and the need. And then if they get declined, pivoting it away from it. If it is, just too much money for them, then pivoting to short-term care, right? Because it's a lot easier to go from long-term care to short-term care than it is to go from short-term care to long-term care, because you just got them all psyched about how easy it is to qualify, how inexpensive it is, right? And then going to long-term care from that standpoint, pivoting off of it, it's a little bit tougher, right? Because now you're going to have to sell a little bit more of, yeah, but you're getting 3 times as much of the benefit, yada, 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 right? And people are very conditioned for price today. It's one of those things that is just beat into us so much through advertising and, what's going on out there. Right. So as I mentioned earlier, we're not looking to give sales pitches. We're not looking to scare the client into worst case scenarios and having them, just petrified of the world. It does work sometimes, but it's not the most effective, especially as we're stepping into these new younger generations. There still is success to be had there, like I said, but it's just not the same closing percentage on them. So really what you're looking at is pushing that this isn't nursing home insurance, right? This isn't just facility. This is recovery insurance, right? Whether that happens to be at home or you're comfortable and you get to see your loved ones and sleep in your own bed, or you do have to go to a facility, this is to help you get better, right? This isn't going to be the end all, your client having flashbacks to visiting their grandma in, a senior assisted living facility going downhill declining, right? This is, and while it does pay for some of that, right, up to a year, it's going to be more of the what if you have a stroke? What if, whatever happens? This is going to help you get better and give you the time to get better and not have to be as stressed and not wipe out your 401k, not wipe out your savings, not withdraw all your investments, right? And it's really cheap to pay for. So kind of going through that route, right? And really along that route, stroke, a lot of people recover depending on how quick they catch it, all that kind of stuff, what's going on, especially in today's world with our medicine. They may not have a full recovery, but they do recover, right? So it's something that's going to be there for 6 months, 7 months, 8 months to kind of help you get back on track, back on your feet, kind of go through all this, pay for it, right? So looking at that recovery angle, right? We're kind of steering them away from that doom and gloom of what they've seen, especially when it comes to long-term care, because that is a lot more people focusing on the long term of what if I'm in an assisted living facility for 3 years, 4 years, right? This is kind of a stopgap between those two. It's something that's going to be there to help, retain some money for them and support them. Also, this is a popular one, but I wouldn't do it in a way that it is going to push too much the fear, but kind of guide them through the process of if something were to happen to you or your spouse, right? Or if they even have a spouse, right? Maybe they are older and it's their children, right, that are out in the workforce. And a lot of people think, well, they're just going to take care of me, right? My kids are going to take care of me. Okay. Well, let's follow that through a little bit, right? Do they work? Are they working full time? Do they actually have the time to be able to get there? Would they have to take time off from work to do that? Would they be able to afford that, right? So you're giving a little bit of that real world scenarios of what does this plan you have in your head actually turn into, right? What are the consequences and results of actually having your children come help you, right? And just kind of asking those questions to get them to walk through it instead of throwing out that doom and gloom of, well, are they going to quit their job and come take care of you, right? just kind of navigate them through the process of letting them come up with the idea and asking the questions that are going to make them think those things and get there, but not just throwing it in their face and saying like, no, you're wrong. They're not going to be able to do this. This is what's going to happen, right? You're there to kind of guide them through the process, to show them really what the need is and why this is a solution for it, right? They already have an idea, but as the agent, we're the professionals. We know what they're going to need. We know what's there, and we're going to help get them to that, right? It's kind of like a guide up a mountain, right? Most people know how to hike. They know how to follow a trail. Why do you get guides? Because they know what to look out for. They know how to take care of you. They know how to guide you, right? So it's kind of similar to that being an agent, especially with a lot of these younger generations. Um, we touched on this a little bit, but this is just to reinforce, right? So many agents are moving to short-term care today because there is still a huge need for the care, right? Whether that's long-term care or short-term care. Difference here is very limited underwriting, so almost guaranteed issue, but not. Very affordable. A lot of people go to it when they have a decline. It issues extremely fast, right? You can see it in as little as a couple days, a few days of putting in the app, bam, they have it, right? Also, it really helps strengthen and fill gaps of what other plans they have out there. So whether it's MedSup, different things like that, this is going to be able to come in, kind of help with some different areas to help protect your clients. Like we mentioned, it's going to help with retention, right? The more products they have with you, the more likely they are to stay with you because it kind of becomes a hassle. Not that we want to give our clients a hassle, but just thinking for myself, right? If I have life insurance or short-term care and MedSup with an agent, and another agent calls me and they're like, "Hey, I can save you $5 or $10 a month." It's like, yeah, then I got to call and I got to cancel this. Then what am I going to do with the short-term care policy or the life insurance policy? Am I going to leave that? Right? It just becomes a bit more of a headache. And it's something where, especially if I have a good relationship with my current agent, that $5 isn't worth it, right? It's probably not worth it to begin with, but especially if I have to move other policies, right? And there's so many studies out there by different insurance, companies and different companies I worked for. And that's part of the reason why State Farm and some of those companies are so into bundling, right? Is because those clients are more likely to stay with you for a long period of time if they have more different insurance types. All right. So really from here, and we get this question quite a bit, obviously if you're not contracted with any short-term care, give us a call, or when we call you out, ask some questions. I didn't put any of the actual carriers in here we have because it is going to vary a little bit based off of state to state, especially which products we kind of push. For certain carriers. They don't all get updated or changed at the same time because each state has its own set of hoops you got to jump through to get things approved. So I didn't want to talk about, this product, which is amazing, but they don't even have it in your state, or maybe they have an older version of it and then it gets confusing. I'd rather save that for the one-on-one because we did get some questions on that for this webinar here, but we'll dive into those when we talk one-on-one. But basically, If you're not contracted, it's a good place to start. Some of the carriers are very, very quick. You can get contracted, by tomorrow if you put in the request today. The other thing I would do is think about who might need this, right? So whatever market you're focusing on, if you have a book of customers and whatever your CRM system is, depending on the kind of notes you have and stuff like that, I would go look for that age range, right? Of what we're looking for. Really in those 50s, 60s, maybe early 70s, and kind of jot down some notes and either do an email campaign, a phone call, whatever you got time for, and just reach out and touch base and see if they have any kind of critical care in place and if they're interested in anything. And start having those conversations with your existing book of business and just check what you can pivot to. Because one, it's going to help you retain those clients, but two, it's going to help take care of them, right? And it's going to give them something they do need. The majority of people in this country need some kind of care, right? As they get into 65, 70, 75, and the number just keeps going up, right? As far as some different options, right, we do have a lot of fun different stuff. For instance, GTL has some really cool videos that are really popular for their short-term home health care. A lot of people watch it. They want to buy it. It's got a really, really good percentage as far as those who view it actually look into getting the policy, right? All carriers have something as far as marketing that's out there that we can hook you up with and kind of go through. We can dive a bit more into the actual products themselves. We do have some different webinars that go into more just specific carriers and their products. So if you go on whyaim.com, click on webinars, and then click short-term care, it'll show you all the videos. It's part of the reason we didn't do it here, and also because, like I said, I didn't want to get someone excited for something that's not in their state. But this is kind of just a general overview of why short-term care is becoming so popular, why you've seen it exploding as far as sales for different agents. It's one of those things where if you're not doing it now, I would highly, highly recommend jumping into the market, giving us a call or wait till we call you and just asking about it, right? Get it going because it is so easy to sell. While the commissions may not be as large as long-term care, because we're talking about smaller premiums to begin with, it is something that starts to stack and add up. It's something that has great retention on the policy by itself. So most of the people who get short-term care keep it and leave it in place because it is so inexpensive. And as you start adding more and more clients with it, obviously your commission is going to keep going up. All right. So with that, I just want to say thank you for everybody for being here. Like I said, we were going to keep it pretty short and high level today, not jump into too much of the weeds. I will be reaching out for some follow-up questions, especially some of these that we got here on chat that are a little bit more specific. And then if you can't wait, go ahead and call in, ask for a marketer, the number's right there. Feel free to email me with any questions. But with that, I'm just going to say thank you to everybody and hope you guys have a great day.